My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics to clarity. This is CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, December 9th, and I'm so glad to be with you. I'm Charles Brown, portfolio manager with CB3 Financial, decked out with my red shirt and green tie for the holiday season. Hope you guys are having a great holiday season so far. Merry Christmas, Happy Hanukkah. First thing I want to do, December 9th, I had my very first date with my bride, Alice, 20 years ago today. How about that? 20 years ago today. Happy 20-year first date, Alice. All right, guys, it's the 2021 review and my outlook for 2022. I'll have a lot of opinions here. I'll have even more, obviously, in January, so come back for that. If you're new to the program, please subscribe to us on YouTube. Click the little button and you'll get updates. Click the bell and you'll get a notification whenever we upload a video or when we go live. Also, follow me on Twitter. I tweet every single day, sometimes twice a day. We're also on Facebook and LinkedIn. Hope to see you on one or more of those platforms. As you know, we have our monthly program on the second Thursday of every month, and that's so that we can encapsulate the unemployment data, which is generally published on the first Friday of the month. And this past month, which was November, of course, data was reported last Friday, and the labor market pretty much back to full employment, at least by the Fed standards. Okay, so 4.2 is where the unemployment rate came in, expecting 4.6, so much, much lower than what was forecast. And that's basically in this 3.8 to 4.3 range that the Federal Reserve calls full employment. That's a good thing. So the focus, as you guys know, since I've gone to this monthly format, is to present to you what's happened during the last month, why I think we're doing how we're doing with our portfolios and why the economy is doing what it's doing. And then the second half of the program looks forward to what I think is going to happen, in this case, in 2022. But the key takeaway from this report is that basically, we have this fickle trading action happening in the market. December's been pretty volatile, unusual. December's usually a strong month. We had 3 really great days to open this week, and today a little bit of a sell-off, but not at all concerned about that. The labor force participation rate ticked up a little bit. Unemployment population, so that's 59% of our entire population is working in October. So those data points lagged by a month, but those, again, are good data points. Where I'm trying to go with this is to encourage you guys as you head into the Christmas season not to be concerned about what you're seeing in the media. I know that I rant on this in every single broadcast, but the people that are putting out financial news, sometimes mostly on TV, but certainly sometimes in the newspapers too, are trying to get eyeballs, and they're not trying to necessarily tell you the truth. They're trying to get you to come back and watch. Here's the unemployment rate. Again, the survey was 4.5, the actual number 4.2. You can see that we're really back to 2017 levels here. It ticked down to 3.6 during the Trump administration, just before COVID came out. Really, the February unemployment report in 2020 was the lowest ever. And of course, you see that huge spike when we shut down the economy. And it'll be interesting to see what history shows about that. It's just a very strange spike, but you guys have all seen this now many times. So that's the unemployment rate. The underemployment rate, that's different than the unemployment rate. Underemployment means these are people that are not working full-time that want to, or people that have left the workforce. That continues to drop. That's all good data. There's just no indication here of any kind of serious problems in the economy at all, despite what you may be hearing about inflation. As you know, I have a special section in a few minutes on inflation. So November changes in U.S. non-farm payroll. Where are we seeing gains? Business services, transportation, and warehousing. This is a shout out to our viewers in Pennsylvania that have that trucking company. We're starting to see jobs being filled in transportation, and we need that because logistics in this country is in real what a mess. And it gets to cargo, it gets to land transportation. Shout out to our viewer in Chicago who works in the logistics industry as well. And appreciate the data that I get from you guys from time to time to add to my own here. But what you'll see is, just in general, business services, the service sector benefited most from this unemployment report. Job openings, now this is the opposite of that. So financial activities, government information services, pretty good shape there. Transportation and warehousing, again, as my friends in Pennsylvania will tell me, they just can't find enough people to drive trucks. My logistics viewers in Chicagoland, we can't find enough people to get us the inventory that we need from boats. We just can't get enough cargo ships. Manufacturing, just more jobs than they can possibly hope to fill. That is what's causing this inflation, which again, I'll address in just a couple minutes. But the other data point on this is unemployed workers per 100 jobs opening. So this is the lowest it's ever been tracked. So this data has only been available for 20 years. But basically, the number of unemployed workers per 100 jobs is at a record low, meaning there are way more jobs than there are workers. Normally, during a downturn in the economy, it's just the opposite. There's more workers than can possibly ever get a job because there just aren't enough job openings. That's not what we're seeing right now, and we haven't really this entire year. One thing we've also seen is revision. So even though this unemployment report in many ways was good, they're going to revise this. You guys know that if you've been watching my show for some time, we put a piece of data out, but then there are two revisions, especially the big ones like the non-farm payroll. So this November employment report is going to get revised again in January when I see you, and again in February. By the time we get to March, then they'll be revising the December data, etc. But I still think these revisions have been strong. Look at the last line on the screen here. Since January, the revisions, that's not the initial data, but the revisions to them, an extra million, almost million jobs there. So what that means is as additional data points are collected, it just continues to look strong for the employment picture in America. Again, you can't possibly have a recession or even a downturn, significant downturn in the market when the basic economy is this strong. The number of unemployed Americans hit a record low last month. Just continues to, and I showed you this in the numbers, but it helps to see this on a graph. Despite that terrible 5% spike in 2020 when the economy was shut down, it's all but recovered and actually fully recovered as far as the unemployment rate, not necessarily the underemployment. You saw that. I know it's a lot of data, guys, but it's important to see this as I combat the media and what they're trying to do to scare you. A record 4.4 million people quit their jobs. We're calling this the Great Resignation. I have some family members that are actually interested in pursuing other employment opportunities, and they're finding that there are just more offers than they can even respond to. And that's because because there is a dearth of workers. And because of this, workers are able to say, you know what? I want to work from home. You know what? I'm looking at a 4-day work week. You know what? I don't want to have to travel. And workers have more clout than they have had in my lifetime. And I like this. It's actually a natural balancing. You know, it's interesting to me because there is a political party in this country that wants to have the government try to equalize things. I think if you just let the market do it, it does a pretty good job. And that's what we're seeing right now. The worker, because there are not enough of them, has more clout than at any time in my lifetime. And that's a natural benefit of the capitalist system. Just my 2 cents, but I'm right on this one. Okay, so 5 job openings for every 4 unemployed workers. That's the highest ratio it's ever been since they started tracking this data. Look at these gray bars here. That's where we've had recessions. How can we be nearing a recession, depending on which news source you're listening to, that, oh yeah, recession is going to happen in the first quarter? We're not even close to these the unemployed numbers that were in 2008, 2009, and 2001. Not even close. Not even close, guys. We are in solid shape right now. And this is an astounding statistic. Initial claims is something that comes out every Thursday. So that's not the monthly data. That's just the weekly data. How many people are trying to get a job? The lowest level since September 6, 1969. I'll confess, I was 14 years old when this data point was even lower. This is an astounding statistic, especially because we are still not post-COVID. We're still dealing with the effects of the COVID horrible pandemic on our economy. But even with that, initial claims at a 50-plus year low here, astounding statistic. So how does this translate into what the market's doing? Okay, in general, I like what I'm seeing. The S&P logged its largest 3-day gain in more than a year. Okay, since November 2020, 3.6% in the last 3 days. Obviously, I said earlier this is a little bit of a downturn today, but not at all an issue. S&P 500 is in the shadow of its all-time high. That's the 500, not the 1500 there, typo, sorry. And it's doing it without leadership from growth. So growth are the huge mega cap stocks, which we'll actually address in just a few minutes. But we're not getting a whole lot of help from them. And you'll see when we get to that slide. But it's encouraging to me that there are other places in the economy that are picking up that slack and still pushing the S&P very, very near a new lifetime high. Just days ago, we hit another lifetime high. So what's doing this? Well, as I say, it's this raging bull market that I've been talking about ever since really the summer of 2020, when I could see pretty clearly that this bear market that the pandemic caused was going to be very, very short-lived. I am thankful because it's helping people to meet their financial goals. I still think we have much, much longer to run. I'll show you the charts in just a few moments. I know the media is trying to find everything they can do to rip this market apart, but it just keeps going higher and higher. Skeptics are pointing to quantitative easing. That's when the Fed gets involved in the economy, the trade war, COVID-19, national debt, et cetera, et cetera. But no matter what, the market continues to go higher. And that's what I'm telling you. The latest excuse, there's always going to be one, and certainly inflation is somewhat of a concern. I'm going to address that in the next module. But here's what I'm telling you. The brilliant MBAs that are trading on Wall Street, they have to be really, really smart and have tons of money to risk to be floor traders and market makers on Wall Street. And if they saw a problem, they would be bailing from the 2 most aggressive sectors of the market. And they're not doing it. In fact, over this time, they've looked very good. Let's look at those charts right now. Don't worry about the squiggly lines. Just note that this chart is going up. What you're seeing here is a comparison of the technology sector versus the S&P 500 overall. What's happening here is showing you that the technology sector is soundly outperforming the general S&P 500. Technology is all the big companies that you know that are tech, and the Microsofts and the Apples and on and on and on, and NVIDIA, okay? The other sector, if it's looking very similar to that, is discretionary spending. This is the most important 2 sectors of the 11 sectors in the S&P 500, and this has been outperforming the S&P. I guarantee you, and I can say that if traders on Wall Street were concerned about inflation, they would see the multiples of these companies, the price earnings multiples come out. In other words, get deflated, and they would not be sinking more money into these two sectors. Technology, which I just showed you, and consumer discretionary on the screen here. It's for this reason, because of what Wall Street is doing, that I am simply not concerned at this time about inflation affecting the market. You guys have seen this chart many, many times. And I'm just going to, for those of you that are new, I just want to remind you, secular bear market is a long-term bear market. You'll see 3 of them over the last 100 years. The long blue lines are secular bull markets. Those tend to last 20 to 25 years, 20 to 22 at the worst case. We're currently less than 10 years, or actually about 10 years into this bull market, okay? The red circles down here are a technical parameter, but basically that's when you need to be concerned. Look to the right side of the chart and you'll see that the line is nowhere near that. From a technical perspective, we have no risk of this bull market ending anytime soon. Now, the minute I say that, we could be down 300 points tomorrow and 500 points in the Dow for the month of December. That does not mean that the secular bull market is ending. In fact, of the 11 sectors, I've highlighted the 3 aggressive ones. That's technology, which we just showed you a chart on, communications, which is Facebook and Google and others, and then the discretionary sector, which is Lululemon and all the places that you spend your money that are discretionary. Just as a brief reminder, consumer staples will be your Procter & Gamble's and Johnson & Johnson, pharmaceuticals, things like that. And consumer discretionary are things that you want but don't need. Consumer staples, just the opposite. So what are the strongest sectors since this bull market began on April 10th, 2013? Okay, so we're still short of the decade mark. I think we have another 10 to 12 years to run on this. Will there be pullbacks? Absolutely. Look at the chart here, and you'll see there were pullbacks from 1950 to 1970, from 1982 to 2000. There were pullbacks in there, but the secular bull market remained intact. We are, I think, less than halfway through this secular bull market. And why do I say that? Because technology, communications, discretionary are outperforming, or they're up 477%. Let me get my eye in here so I can see it. 334 and 206% versus the S&P, which is in purple, at 179. The sectors that are in red are the defensive sectors. Nobody wants to be in them. Why? If Wall Street thought that this secular bull market was ending, they'd be buying those conservative defensive sectors. They're not doing it, folks. And that's why you're seeing that those gains are much smaller. Energy for the last 9 years is actually negative. Okay? So based on that, the Magnificent Eight are what's really been driving this year. Alphabet, which is really Google, Amazon, Apple, Meta, which is really Facebook. It makes me wonder how many more of these companies are going to change their names, and we're just going to have to put their old names in parentheses so we can remember who they are. Microsoft, Netflix, Nvidia, Tesla. For the record, yours truly owns every single one of these. If you're a client, you'll see these in your portfolios if you have our full complement of 4 programs. Okay, because we don't always put the same exact programs. Obviously, the same programs are not listed with the same stock. So at any rate, these have been the big performers this year, the mega cap stocks, we call them. Okay, how many record closes have we had? We've set a 40-year record on the number of record highs this year, even more so than last year, when the returns last year were actually higher than they've been for us this year. But as far as record highs, this year has been the best in more than 40 years. Why does that excite me? Because it means there are multiple sectors and multiple asset classes participating in this secular bull market. As long as everybody's joining the party, even if our stocks in a given tiny time frame, and a year is in this relationship, then it means that the secular bull remains intact. And that's what we want to see. Okay? Now, you guys have seen this before. This is the reporting of S&P 500 stocks. We're very near the end of the fourth quarter, which is, of course, reporting on third quarter earnings. 495, there are only 5 left to go. Look at these beats. The average, remember, is about 73% of companies beat what they project they're going to say. You'd think it would be 50, but it's more like 73 because they aim low so they can always, surprise, we did better. Look at technology, 93% beat. Industrials, 85%. Healthcare, financials. This is great data. If you had companies surprising to the downside, that's when the market drops. Because the people that have invested have gone, hey, you said you were going to outperform. You didn't do it. You misled us. See ya. And they sell. And I mean big sellers. But you're not seeing it. You're just not seeing it because the expectations are being met. So this is where I pause. This is where those of you that are clients, and if you're not a client, you're just welcome to see how we're doing. This is where we rank how the indices are doing. Those are in black. So the NASDAQ, the S&P, the Dow, and the Vanguard balanced. We use that because our conservative programs, diversified growth and growth in income, really don't compare to the S&P and the NASDAQ just because they're more conservative. You can't really put a Volkswagen and a Ferrari in the same race and expect the Ferrari not to just demolish the Volkswagen, okay? So we're real happy with our 3-year returns and capital growth. Strategic growth just overtook the S&P on a 3-year basis. This is, of course, after all our fees and on a 5-year basis. We don't have a 5-year track record yet with strategic growth, but we do with capital growth and beating the S&P by 210 basis points after fees. Happy about that. Those guys, those folks of you that are in our programs, I hope have enjoyed having a good year. Not quite the blockbuster year we had last year, but again, when you average in 3 and 5 years, still pretty good. Take a screenshot of this. If you have any questions about our performance, these are from Alice and my actual accounts, our trust account. We are a family office. We manage our own money, and all of our clients trade the same programs that we trade, but not necessarily the same weighting of each of the programs that we trade because each of our clients has a unique risk tolerance. So we custom tailor our programs and our blend of programs to each client's desired risk tolerance and financial objectives. So the economy. So where could things go wrong, basically? You can see how things are going in the past, but now I have to use this part of the program. I choose to use this part of the program to look forward to see what possibly could throw us off in 2022. Inflation, certainly the most talked about target, the most talked about entity out there. It's the target, if you will, of all the broadcast media. So U.S. inflation expectations surged to another record high from the New York Fed and the New York Times. What a shock. The New York Times, one of the really trustworthy sources of news out there. Not, okay? So last April, economists thought inflation would be around 2.5%. Instead, it's over 6%. Okay, not in every sector, but in certain parts of the economy it is, yes. So even by, forgiving standards, that's a miss of epic proportions. I'll give you that. I don't want you to think that I'm either a perma-bull or a blinders on about inflation. I'm not, but I'm also old enough to have been here before. We'll get to that in just a minute. As far as the recency bias, that's a term I use a lot for people that get concerned about how their portfolios are doing, and that's because they're looking in the last day and a half, 2 days, 3 days, 5 days, rather than the last 5 years, okay? So why is this happening? It's happening because of strong demand. We haven't seen anything like this, really, since the aftermath of World War II. People came home from World War II, August 9th, 1945, declared victory in Japan, or that, basically wrapped up both sides of the World War II, and people got home and not only made babies, but decided to spend. And there was not enough production because factories had retooled for munitions and things like that. So we're seeing that sort of thing now. We were retooling, if you will, for PPE. So personal protection equipment and other things. And the airlines, for one, have been caught flat-footed. That's why you're seeing thousands of flights being canceled. I go into a restaurant still every once in a while and I go, there's like 30 tables there, sir. We don't have anybody waiting on them. The line is 30 minutes. It's like, there's 30 tables. No, it's 30 to 45 minutes. See ya. Okay. So it's going to take more labor to get this fixed. All right. I still think a lot of this inflation has to do with COVID and what I just described to you. COVID just literally turned the economy upside down. One, because it was a pandemic. Two, because of the fear of it caused. Three, because the federal government under the Trump administration and the Biden administration have way overstepped. The blue states have even more overstepped than the red states at the more local level. And the economy just took a huge gut punch, in the second quarter of 2020 and is still trying to recover from that. And then we continue to have these variants. I mean, literally just in my family today, I got 2 different texts from extended family members saying, guess what? We've got a COVID case here. I mean, I don't know when we're going to be done with this, folks. It's just a hideous disease, but life has to go on. So I mentioned earlier that because I'm an older American, I have a different perspective than younger people. And that's because I've been around and I've seen what high inflation is like at other times in the economy. So that's why I'm part of this here. So this is asking, so when do you expect the supply chain disruption will end? Well, the peak of it, most people are saying well over 60% that it's this quarter. This is where the disruption is going to end and it's going to taper off. Okay, some people think it's already ended, but most of the responders here think it's going to take through the end of this quarter, which frankly is just, a couple weeks away. But we'll see how that plays out. But that really is what the focus is, the supply chain disruption. There is way more demand, way too much money chasing way too few goods. Okay, I mentioned earlier about fewer people with inflation experience. So those of us that are 55 years and older, we're here in the 80s and we remember what that terrible inflation was like. But for those 18 to 54 years, this is a new experience for them. So 77% of them are more concerned about inflation than those of us at this age. Because why? We've been there. This is the recency bias. If you've never lived through a high inflation period, everything seems like Armageddon is going to happen now because prices are going up 2%, 3%, 5%, 8%. What's going to happen when we're like Venezuela? We're not going to be like Venezuela, okay? I'm going to show you a chart of Venezuela in just a minute, and a little bit of a warning, but we're not headed there, okay? U.S. jobs opening monthly, again, 22-year low on this, way too many openings and not enough hires. The only reason they're not hiring is because they can't find people to fill the jobs. I'm showing you this data because this would have to be flipped over if we were anywhere close to a recession or any serious financial harm. As long as there are this many people that have job openings, businesses that are saying, please come work here, you can't enter a recession. You just can't. Now, this is 1 year change over change consumer price index. And again, boomers, because we've been alive longer, we've seen this high inflation. See the spike there back in 1980? I lived through that. Those of you that are on this program tonight that are my age or around that know what this is like. But look at the millennials and Gen X. They're going, well, we never had anything like this. That's true, you didn't. But listen to us, okay? We're going to get through this. The supply imbalance is going to correct itself, and this inflation is going to come down because either people are going to say, no, I'm not paying that price and keep their money, or supply is going to come in, these boats are going to get unloaded, and then people are going to continue to spend, but because there's more product, it'll drive prices back down. Either one works for me. The latter is better for sure, okay? The fact is that inflation is actually perceived worse here than it is in Europe. Look at the blue line as to how we're perceiving it here, and look at the red line for how we're perceiving it in the Euro area. Now, they also have trade imbalances, but they don't have boats sitting out in the Mediterranean Sea or off the coast of the Atlantic, off Spain and England. They don't have the same delivery issues. They have some. In fact, as I say, I've got my transportation contact that watches us here and is in logistics. And I just don't believe, feel free to type in the chat if you think that the issues overseas are as bad as they are here in America, but I don't think that they are. So anyway, so chain reaction, this is this bottleneck that we just keep seeing. This is going to unwind itself. You saw the chart about 3 charts ago where I think this has reached a peak and it's going to continue to taper. In other words, return to normality very soon. It may take 6 to 8 months. Now, is that very soon? I guess it's all perspective, isn't it? It's not going to be next January or February. It's probably with us another 6 to 9 months. Can the economy continue to grow and expand even if it takes that long for the supply chain imbalance to correct itself? Yes, I think it can. All right, before I start on COVID, I'm going to get a sip of water here. And I'm going to check questions, see who's here. Glad to see you all. Appreciate you being here. Merry Christmas, etc. Okay. Client reports to me that we had to drive this week from Montana to Tennessee. Reported there were thousands of trucks on the road. All had signs on the trucks saying they were hiring. Yeah. So one of our viewers from Montana, passing through Tennessee, said literally the trucks are advertising, not the companies, the truck drivers themselves, like, yeah, do you want work? Right here. Good to see you, T. I see the thumbs down from Charlie. Not sure what that means, but maybe you can explain it. NVIDIA to the moon. I think that's probably true. Hey, Kate, or Patrick Tate, new viewer, I think. I don't know if you've been on here, but anyway. You mentioned that inflation will be temporary, but the Fed was saying that temporary should not be in the vocabulary. Kay, I hear you on that. I think Jay Powell underwent some significant pressure to say, I think we need to take transitory out of our vocabulary. Okay. So my take is what I showed you earlier. The market wins. If the technology sector is outperforming the S&P, and the technology is without a doubt the riskiest of the sectors in which to invest. Discretionary, consumer discretionary would be the second riskiest sector in which to invest. Both of them are outperforming the S&P and have been for months. When those start falling back and the S&P starts outperforming those high risk sectors, it means that big deep pockets on Wall Street are pulling their money from those sectors and stocks in those sectors and putting them into more conservative allocations. Then I'll say, okay, maybe Wall Street's scared of inflation, but I'm not seeing any behavior in the big Wall Street banks and investors and hedge funds that are indicating that they're concerned. I'm just not. So good question. Thanks for asking it. So on to COVID, guys. You've seen the data here. The 2-week trend is kicked back up because of this Omicron, yet another variant. So the number of cases has ticked back up. The number of deaths, I should say, has ticked back up. I don't think you're going to see it overtake this peak from back in September. I just think this is just going to be with us for a while, guys. I'm not sure how they're going to do this. You're seeing now that Pfizer just got approved for a multi-purpose flu shot that will encompass all of the updates with COVID plus the traditional seasonal. I had to get 3 shots when I went to my physical to make sure that I had everything covered with pneumonia and COVID and the general flu shot. And somehow I got out of there and didn't have any after effects other than my arms were a little bit sore. And you're welcome, Kay. Glad you like the answer. So Omicron, yes, latest strain, variant of concern. Sure, you've got to say that. World Health Organization. I get that. More countries are going to continue to report cases. I get that too. You just can't listen to that. Here's the status that matters. If people are concerned, they're not going to go in closed indoor events. They're not going to go to indoor concerts, and they're not going to fly on planes. Everything that I'm seeing is that air traffic is back. This is reported by the TSA, back to October of 19. All right. That's a big deal. That's a really big deal. Basically, people are saying, no, we're not just going to let this wear us out. We're not going to do it. We're going to fly. And that to me says that the general population believes that COVID is beginning to be in the rearview mirror. So politics, as you know, leads to policy. Politics in and of itself is not something we need to discuss, but it does lead to policy which affects us at our portfolio level and at a personal level. So the major legislative accomplishment, if you will, of this administration that has happened since I did my last program was that the infrastructure bill did pass. It is now law. It's no longer called a bill. Okay, there is another bill floating through, and that's what many people are calling the social handout bill, $1.8 trillion or whatever. Build Back Better, whatever they want to call it. But this has more significance because improving our infrastructure kind of makes you wonder. We're paying all these toll road fees and everything, and we pay taxes at the state and federal level for transportation. Is none of that getting used? Why do we need to raise more money? Nonetheless, it's still important. You can see the percentage here, mostly roads and bridges. I can give you the graphic on this if you just want a perspective. If you want to do a screenshot on this, it might be helpful. Roads, bridges, airports, rail, Amtrak, public transit, broadband. I mean, these are all important things. We are behind the rest of the world. And it's because we can't get legislation passed to get this done. Donald Trump, I have those of you on the right that get upset with me. He should have gotten it done in his first 2 years when he controlled the Senate, the House, and of course the White House. All right. But it needs to happen. And I hope that this money is indeed going to go to these areas where it says it is and doesn't get sifted off somewhere else. That's the goal. So here's Putin and President Joe Biden on this call. I don't know why they did this. Putin is totally untrustworthy. Biden, I don't think, has any real idea what's going on, in the area that Putin is trying to expand Russia. I still think that they're sore from the Soviet Union from 30 years ago. And so Putin is trying to expand into other areas. And we're basically saying, if you do that, we're going to, hit you with serious financial damages, and it's going to hurt you. And it would be great if we didn't have England and France and Germany, mostly actually Germany and France, saying, yeah, we're going to buy all the oil and gas that you'll send us, mostly gas. But they don't want to join in on this embargo. So at any rate, this is just an interesting chart from Ray Dalio. This is he's the largest hedge fund trader in America, probably the world. And you can see here the history of the United States, the United Kingdom, England, China, and the Netherlands. It's hard to believe the Netherlands was actually a pretty powerful force, mainly because of their navy. In the 1600s, 1700s, and then, of course, once America was formed, it just took off like a rocket. He thinks that America's on the downturn. I don't believe this, but I do believe that it's important that our federal government and the policies that are developed are primarily economic and not social, because you can do all the social change that you want, which actually could be done at the local level and state level and not at the federal level. If the federal government would just focus on economic change and economic improvements and economic empowerments, I guarantee you the Chinese are doing that. Now, would I take China's approach of having, oppressing their people and, having no, human rights to speak of at all in China? I would not. But I do think the federal government's focus needs to be on the economy and the economics that benefit Americans, and leave the social change for someone else, a different arm of the government. I said I'd mention Venezuela. Just read through what happened here with this country. So it became the third richest country in the hemisphere. All right, second largest purchaser of F-150s. Okay, those are airplanes, big airplanes. Okay, voted for a socialist president who stressed income inequality was tearing down their country. Okay, private health care completely socialized, which is what's trying to be done here. Higher education becomes free. Again, you will see that here on the Democrat side. They want everyone to have access and free access. Socialists started banning private ownership of guns. Of course, you see that here right now. Bernie Sanders praised their American dream. That's the part that's really scary. So let's highlight that. Okay? And then you can read down the list, but basically it took one generation of progressive leadership to plunge Venezuela into civil war, anarchy, and poverty. Third richest country in the Western Hemisphere behind Canada and the United States, and now it's completely in disarray. Is this what you want if you are voting for federal government leaders that are focusing on these policies that are not building us up economically? That is a concern that I have. I said this is section of the program is what my concerns are. One of my clients sent me this. I thought it was very poignant. Never blame someone else for the road you're on. That's your own asphalt. Okay? So we have to own what we've done. If you're voting for for entities at the federal or state level that are not creating a stronger, more robust economy, which is strength in power, basically, with strong economies, then you can't blame somebody else because that's your own asphalt. All right? You following me on that? Now, here's someone that I really respect a lot, a man of color, who could be talking about how the injustices of America, and basically, gone on the wagon with some of his other people that are men and women of color. But Denzel Washington has a very different take. This is a very short video, but I found very intriguing. It's less than a minute. Listen carefully. He speaks quietly, but he says volumes here. Whoops, let me get it here, guys. All right.
Grandfather walked 10 miles to work every day. My father walked 5. I'm driving a Cadillac. My son is in a Mercedes. Said my grandson will be in a Ferrari. But he said my great-grandson will be walking again. So I asked him, I said, well, why is that? And he said to me, tough times create strong men. Strong men create easy times. Easy times create weak men. Weak men create tough times. He said to me, many will not understand, but you have to raise warriors.
And if we're not raising warriors, other countries will be doing it. So again, this part of the program is where I express my concerns. I want an American people that want to be self-sufficient, that want to contribute to the economy, that realize that freedom is precious and freedom is not guaranteed. And we are living in a situation right now in America where I believe there are forces trying to break that down. And people like Denzel Washington and other very successful people of color, minorities, if you will, are expressing their opinions and saying, you guys got to be careful, really, really careful. So economic indicators, what am I watching as we move from 21 to 22? What about Amazon's outage? Can you believe that? I kept saying, Alexa, Alexa. She said, I can't connect. And now she's going to try to talk to me. Never mind, Alaska. I really wasn't talking to you. Okay. But Amazon was offline for 11 hours. So what did it affect? McDonald's, Robinhood, Coinbase. You might not have been able to get a Big Mac in certain part of the countries, right? Streaming services, Netflix was down. Walt Disney's theme parks couldn't collect tickets. People trying to book or change trips with Delta, some smart light bulbs, and even Roomba vacuum cleaners stopped working because all of these entities are on Amazon's cloud. Well, their head may be in the cloud, but their reliability sure took a huge hit this past Tuesday. So that's an area that concerns me. This is when the regulators come in and say, oh, we got to break up this company. Well, maybe you just need better security. Okay. But it was a biggie. It was a real biggie. And it gave you a little bit of a sense of fear of what it would be like if we did have a terrorism that took down any kind of the utility grid or the economic grid or obviously the internet. So anything else? Yeah, quite a few things. This is a positive. Look at their fulfillment centers. I mean, the people are buying stuff, folks. This is the number of facilities. They crossed over 2,000 facilities worldwide for fulfillment. These aren't 100,000 square foot buildings. These are 3 million square foot buildings that robots put packages together and they ship them out to you. You can get deliveries here in Nashville at 2 a.m. if you order it at 7 p.m. It's just amazing. So this is a positive. So I'm not picking on Amazon. I'm just saying you guys got to clean up your act a little bit, but bravo for increasing your fulfillment centers. Exports look great, right? 20-year highs for exports until you look at this line merged with imports. Why are we still importing? A huge component of this is the amount of fossil fuel that we're importing from OPEC. Why are we doing that? Because the current president, hours after taking office, shut down the pipelines. and basically said the American independence of energy is not important now. So what we have is the inability to produce as much oil as we were producing just a year ago, in fact, less than a year ago, and we're going to OPEC and having to ask them for more energy. That's the biggest component in these imports. Obviously, there's consumer discretionary, there's other items in here, but think about this again. Who you elect makes a difference. And from my perspective as a portfolio manager and the guy managing your money, if you're a client online, I mostly want the federal government to facilitate a free economy that gives us all the best opportunity to succeed and grow our portfolios. Okay, personal savings rate dropping. Okay, so people were saving like crazy. The reason they're not saving like crazy now is because they're confident that this is going to be behind us. The bump that you see in 21 is when the Delta variant came out. I'm sure there's going to be another bump when the Omicron data comes out, and the next variant after that, and the next one after that. But you see that they're lower bumps. In general, Americans are saying we're going to be okay, and that's why they're spending and not saving as much. You guys probably remember Smoke on the Water by Deep Purple. I love it when these guys put out these graphs. Choke on the Water is here from the Marine Exchange of Southern California. Basically 80 ships, the number of vessels waiting in San Pedro Bay, which is the Los Angeles, Long Beach area. So as I said, I've got a family member that's involved in logistics. We talk about the number of ships out there. In fact, in last month's program, I showed people waiting for Black Friday, and they were out in the water in their bathing suits, basically waiting for the ship to come in because they weren't even going to wait for it to hit the stores. They were just going to get the stuff right off the ship. But this chokehold just continues, and it started in basically a year ago. It ebbed during the summer, but now it's at lifetime highs. This has to fall off. It has to get back to a norm, get back into a range of expectancy to get inflation back to where it really needs to be at about a 2.5%, 3% a year, which is fine. Separated at birth, obviously the spelling is a little different here. It's 21 days on average to enter the port of LA. That means you show up from China or wherever you're coming from and you just sit there. Hope you got a lot of TV dinners on board, right? All right. And there they are. 21 days to get in. This has to change. This is a stat we're watching very closely for 2022. Number of small businesses not able to fill. For the first time since I've been showing the statistic, look carefully at the blue line. It's over 50% of small businesses can't find enough employees. Again, you can't have a recession when you've got a number like that because it means there's still demand for jobs. Recessions happen when there are people that want jobs and they can't find them. We are so far from that right now, guys. Household balance sheets have never been stronger, even with the savings rate dropping off, still very strong. I want to check the board right here. It does not take too much imagination to see Venezuela in America. And Kay, you're absolutely right. Denzel, yeah, I loved that audio clip. I don't know where I got this. People send me stuff. Guys, if you think you got a video or an audio clip that would be good on the show, send it to me. Some of these things that I use come from viewers of the show. Cartoons. There's one coming up here. If it's from one of our viewers in Ohio, which thank you in advance for that, okay? I used to drive Vincent Thomas Bridge over Long Island Beach and can't imagine. Yeah, I hear you, Martha. It's crazy. So household net worth, again, new lifetime high. People are making money. They're saving some, but they're spending, they're investing. Obviously, their stock accounts are doing better. Their homes are doing better. I'm going to have in January my take on where real estate is going. I think we are entering a I don't want to say multi-decade. I'm going to say a decade upturn because real estate prices have really flatlined. I mean, they've kind of kept up with inflation, but I think that demand is going to just continue at this pace, and real estate's a serious asset class, which will be in my asset allocation video, which I will promote at the end of the program. So the Fed, Jay's staying with us. How about that? He's back. And of course, the far left person who was going to go for the office of Biden wisely elected or decided to reappoint Jay and put her, I forget her name right now, guys. Maybe somebody put it in the chat if you know it. She's the vice Fed chair now, which is fine. So Powell will be there for, I think it's a 6-year term. So He has had major policy shifts. We're waiting to see what they say next week, basically saying we're going to start tapering, which means buying less bonds. Okay. I think he's concerned about inflation. He's more concerned than I am because, again, I listen to Wall Street more so than I do him. Someone asked me earlier about that, and that's why. When Wall Street starts showing me concern, and they do that by getting out of the risky sectors and getting into the conservative sectors like real estate, utilities, consumer staples, then I'll, get on the bandwagon of, yeah, inflation's a real problem. I'm just not seeing it right now, guys. I'm just not. I understand you may be paying more, but I'm a portfolio manager. I don't manage your household budget, okay? In the crypto update, kind of quiet. This was sent from my buddy in Ohio. Thank you, Dr. J. All right, I'm Johnny Bitcoin, and here we are in Nashville, and I can just imagine this guy playing at the Grand Ole Opry or something. Crypto country. Certainly, the point of this is that crypto is becoming more widely accepted. It's been a big year so far. If you look at the far left, the Bloomberg crypto, this is taking all coins, or at least the top 500 coins in volume. Started at 1,000, it's trading at 3,000. So, that's a triple. Obviously, lots and lots of volatility. Definitely not fun to trade. I try not to put my account up on the screen too much because I don't want to freak you guys out. It's been a good year, but yeah, kind of crazy. Volatility. Only thing to watch on this is the downside. You see the red arrows? So what this is a chart comparing Bitcoin to Ether. So some people say, well, why don't I just put everything in Bitcoin? Let's just make it easy. I'm just going to buy Bitcoin and walk away. Maybe not. Okay. So Ethereum, Solana, XLP, there are quite a few different coins out there. And I'm not going to recommend for you, but just realize that there are other coins, and certainly Ethereum is a serious challenger right now to Bitcoin. If you're going to trade cryptos, you want to have a little bit of Ethereum, in my opinion. U.S. housing market, really strong. Toll Brothers, one of the biggest national builders, basically doubled its earnings per share from a previous year, just demolishing estimates in the process, okay? They've got an order backlog, continues to climb, up 49% year over year. They just cannot build homes fast enough. All you got to do is drive around here. Our daughter from New York came in recently for Thanksgiving and said, everywhere you turn, there's a crane somewhere. And it's true. There's commercial, but there's a ton of residential going in. Just down the road from us, 17 executive homes. And before they built the first one, completely sold out, Thanks for looking, but see ya. You'll have to look somewhere else. Already sold before the first person had moved in. I'm seeing housing starts reverting back to the pre-COVID trend. I like that. That's basically the housing market saying, you know what, we're the largest discretionary. Now remember the two sectors, right? You got technology, consumer discretionary, largest two risky sectors, very strong, beating the S&P. What's the largest component of discretionary spending? Housing. All right. And the trend, the green line, is back to the pre-COVID trend, which is the straight line, the dotted line. It was, way above it. It's coming back. But still, we're seeing housing starts back to where they were. They are just not even looking in the rearview mirror versus, other sectors of the economy that are still reeling from the effects of COVID. The Zillow Home Index value, lifetime highs. Of course, Zillow's only been around 20 years or so. Still very positive. From Fred, the median sales price. If you're a new reader to our show here, Fred is, the last name is not Flintstone. This is the Federal Reserve economic data, pretty important data source. I always feel like I need to, qualify that this is not Fred Flintstone predicting the economy here, but this is median sales price. We're at lifetime highs, just continues to rise. Luxury home demand is higher than even the typical, more traditional home builder. So the bottom line here is, despite supply chain headwinds, I got to take a sidebar. We were in Costco a few days ago, and I said to Alice, do I see that those 4 chicken breasts are $68? She said, yeah. But of course, you pick it up, though, and it's like a brick because, Costco sells like there weren't 4, there was 8. Okay, still kind of expensive. But despite these supply chain headwinds, housing remains strong. And why is that so important? Because it's the biggest component of discretionary spending. Okay? Biggest component. So we want to see that continue to stay strong. All right, let me pause here. Yeah, thanks, Doc. It was great. I saw where some Wall Street firms were buying houses in bulk. So I talked about this 4 episodes ago in a suburb in Houston. They put up one of those signs saying all houses sold. And even the newspapers came out and said, what are you talking about? You couldn't possibly have sold 86 homes before you built the first brick, the first foundation. And the company said, well, yeah, actually, there was a hedge fund that just came in and just bought the whole development. Just bought the whole thing. It's the biggest sale of a public entity buying private homes. So, and then they'll resell them when they think the market, is stronger. So, yeah, it's hard to believe that sort of thing is happening right now. But that's what happens when you get an invigorated market in an asset class that's been quiet and sort of ho-humming along. And that asset class is residential real estate. Okay, answers that question. How about Zillow messing in the real estate market, finding out the hard way? So that's true. So Andre's referring here to Zillow kind of getting shut down about the whole flipping thing. Zillow, I don't really know how they make money. I would be glad to just pay them if they had a really good rating service where they could, and I do track them, pretty regularly, but they expanded beyond. They got too big for their britches, and so yeah, they got in trouble with that whole house flipping thing. So. Okay. So I started this asset allocation, a few months ago, and then I said, look, it's just too much. I got to do a special episode. I'm planning on recording this between Christmas and New Year's, which is traditionally a little bit of a quiet time in the market. So, and here's why. This is from a prospect that I actually did not take, but they said, I called you because I did a little bit of financial planning. It looks like I can retire at 62 and live comfortably for about 11 minutes. That's a real line, folks. And so once I saw their financial picture, I said, probably I'm not the right guy for you, but, we appreciate it. It's a great line. You need to look at cash flow over and beyond your actual investments. And that's, for those of you that are clients, about E-money. You usually go on and you see it. You've got it on your phone. If you are not using that and you want some help with that, I can do it. If you are watching our show and you just want to see what it's like to be able to track your investments, you can do that without even being a client. I can give you access to E-money if you want to do that. So you can see if you were to retire at age 62, if you could live for longer than 11 minutes. I certainly hope so. So investment goal, how do you get to $1 million? I've been talking about this since 20 years ago, when I first started in the business. When's the best time to plant a tree? Answer, 30 years ago or 20 years ago. Second best time, today. It makes an enormous difference when you start. Now, whether you invest at birth, and I don't know if your babies are going to get Robinhood accounts, but the difference between 5 and 10 and 15, not that big a deal. But the older you get, it takes more and more and more of a monthly investment to get to this $1 million level. We'll cover some of this. Hope you guys will watch that episode. Again, I'm going to try to do it between Christmas and New Year. So that's the program tonight. I've got something I want to show you, though. If you want to think about your last questions here, that's what we covered tonight. But I'm going to call this Christmas Courage. So the Christmas story, for those of us that are believers, and if you're not, just hang with us, was one of immense courage. And it's really difficult to imagine having a baby in a stable, unwed mother. The whole story is just supernatural. And the story I'm going to show you is not certainly that supernatural, but it's about a person who is very near and dear to me. In fact, there's a listener online right now who has my same name. It's very near and dear to him too. And I just thought that you might enjoy seeing this as it relates to courage. It meant a lot to me. I hope it does to you too. I believe that, folks. I don't believe there are any losers. I don't believe this country is a loser. I think America is the most incredible place on this planet that's ever been devised. And I think we're going to continue to see that play out. So rather than ending with Timothy tonight, I want to end with, may the God of hope fill you with joy and peace as you trust in him, from Romans. For those of our friends that are Christians, we wish you a Merry Christmas. For those of you that are Jewish and other religions, happy holidays, happy Hanukkah. For all of you that have watched our program this year, we humbly thank you. We never take it for granted. I hope that as clients, you've been kept up to date with what we're doing on your behalf to manage your money, to grow your wealth at the best risk-adjusted rate of return. For those of you that are viewers that might want to be a client someday, keep watching. We hope that you'll see what we're doing here and want to make it part of your financial objectives. But my goal and Alice's goal with me as we run this company are to continue to produce quality programs, quality education, quality portfolio management. We are here for you. At CB3 Financial Group, we don't just manage your assets, we become one of them. And so as the year winds down, again, I wish you the very best of holiday season, and may God bless you this year, this coming year, and always. We will see you next year.